Hey everyone, this is Robert Keents with goldsilverpros.com, and today's topic is going to be what is going on in the commercial real estate market, including retail. There's an absolute breakdown of the system going on, and I'm going to jump right into it and show you the research that I am seeing. And we're going to start off with a story here on from CNBC recently that came out June 9th. 25,000 stores are predicted to close in 2020 as the coronavirus pandemic accelerates industry upheaval. We have been seeing a hollowing out of the retail space in the US the last few years due to a lot having to do with online properties such as Amazon, Walmart, so on and so forth, online shopping. But also, I believe overall retail sales have been going down. I wrote a story about that last year. I compared the increase in online sales with the decrease in brick and mortar sales, and there was an overall decrease in retail spend. Of course, that has a lot to do with the amount of credit that consumers have and how much spending they can do, which has been falling in the last couple of years. Well, due to the coronavirus epidemic, now experts are predicting 25,000 stores to close in 2020. And that would be, I think, roughly doubled. I think it was 9,300 or so that we had last year, which was a high itself in recent years. So we're continuing to having this upheaval in the retail space, and I don't think it's going to stop anytime soon. I also have a report from MoneyWise about which chains are closing the most stores in 2020. I wanted to walk down that with you really quickly. GNC so far is the largest. They think they're going to close up to 1,200 stores. Pier 1 Imports is set to close 936 stores. We have Sage Stores set to close 738. GameStop is expected to at least close 320. Signet Jewelers, 300. And this is particularly interesting because a few years ago, I was writing about value stocks left in the economy. I believe it was 2018 when I wrote this article. And I did a filter, a value filter across the entire, basically 900 stocks in the US. And I said, which ones may be values, which ones may be distressed, but have a good value in them. And I mentioned Signet in that post. It came up in the filter that they had some issues, but were turning around, had a turnaround plan. I was somewhat skeptical as whether they could do it. And it turns out, in 2020, 2 years later, they're just not able to turn around, especially in this coronavirus influenced economy that we have now. And so they're going to end up closing 300 stores. We have AT&T, the second largest wireless carrier in the US, closing 250 stores. Victoria's Secret closing 250 stores. Chico's restaurants closing 250 stores Tuesday morning, 232. The Gap, 230. So you're seeing a lot of traditional names in this space across the sector of different consumer goods closing. And of course, this list goes on. We know JCPenney's been in trouble for years. They're closing 204. The Children's Place, 200. Art Van Furniture, 200. Walgreens in the convenience store space, 200, and pharmacy space. Destination Maturity, 183. Papyrus, and the list just goes on and on and on. And of course, there's more news coming out about, will retailers get a boost with back to school? There's tax holidays in many states for back to schoolers where you can get tax-free purchases over 1 or 2 weekends, school supplies, clothing, and necessities. We have that here in Texas. And every year, across the nation, going back to school provides a lot of boost to the retailers and their revenue and their margins. And in Retail Dive, they're talking about because of COVID-19, we may not see that boost that occurs from back to school sales. It says the usual end of school euphoria went missing this year as the COVID-19 pandemic sent students home to complete the semester virtually. Many areas are opening back up with retail stores and restaurants finding a way to cater to consumers, even as social distancing remains a priority. But the pandemic isn't over and continues to cast a shadow over the near future that leaves students and their parents and teachers unsure what school will look like in the fall. I can tell you that my local school district and all of the ones in Texas are coordinating potentially having only certain students show up on certain days and the rest of them learning virtually. So they may go to like an A-B rotation where certain students are in school, like Mondays, Wednesdays, Fridays, and certain students Tuesday, Thursdays, or they thinking about pushing a lot of students into their virtual schooling programs. So certainly if kids are going to be in virtual schooling programs, they're not going to need as many books, pencils, spirals, highlighters, stuff like that. They're not going to be buying as many clothes. So I don't expect the economy to get that boost from school age kids going back. Here's another article in Retail Dive talking about retailers survived the COVID-19 closures on borrowed money. Can they pay back? So now I wanted to get into the finance portion of what's going on behind the scenes. And this is talking about revolver draws, bond issues, deferred rent, and vendor payments. The industry racked up a slew of new liabilities because of the pandemic. And this article goes on to say that companies are doing defensive draws against their credit lines, and there will be an impact. The draws come first, but as life returned to the credit market, other retailers raised cash by selling new bonds. So there is a lot of new debt coming into the retail sector. And the article goes on to talk about road to repayment and how that's going to be done. It's going to be difficult for a lot of the retail outlets really to get back on their feet, because not only have sales slowed down, not only may we not get this back to school boost, not only are there going to be a lot of store closures, but there's a lot more debt coming in for those retailers that are staying in business to continue operations, because their revenues just have not recovered from pre-COVID. So we're going to go up to another story here. This is an interesting one from CNBC. Let me increase the screen size here just a little bit. So the biggest U.S. mall owner, Simon Property, sues Gap over skipped rent payments. So it goes on to say that Gap had missed $65.9 million in rent payments, and this story was dated June 4th, so it's pretty recent. A lot of retailers aren't making their rent payments. Some states are trying to provide forgiveness programs for retail outlets and stores and small businesses as well that are not able to make their payments, but that leaves landlords in a lurch, because how are they supposed to make their debt payments to their lenders? And nobody's really come up with a comprehensive plan for that. I know that the Fed is offering some programs to help out, but that just puts more debt into society, and that's not really a good long-term answer. There's a really good report from Trepp that I wanted to highlight, came out at the beginning of June. It is talking about their measure of the delinquency rate, setting records for the largest ever monthly jump in May. So I wanted to show you a couple of graphs here, because they all look like hockey sticks, and hockey sticks in economics are not a good thing. That typically means we're starting to get into late cycle credit maturity, and it's a biggest predictor of recession when you start seeing hockey sticks on charts like this. So in chart 2, they have delinquency rate by property type. Of course, they have it, for all of these different types, but you see the percentage, and this is percentage of CMBS marked as 30 days delinquent. Look at that spike from 2.29 in April to 7.15. Just a ridiculous spike that's one of the largest ever. In fact, it is the largest ever. Then you're seeing the 2+ delinquency rate. So this is where there've been 2+ months of delinquency has jumped to 6.19. And they're saying the overall delinquency rate has climbed 481 basis points and made a 7.15%. And the all-time high was 10.134 in July 2012. That was a few years after the last mortgage crisis. Percentage of CMBS in grace period or beyond grace period, which is slightly less than 30 days behind payment. So it's not 30 days past due, has jumped. It jumped to 807 and then down to 7.61. So a little bit of improvement there. But again, look at that hockey stick going along here in the low 2s, and then boom, 8%. Going along here under 1, and then boom, 6.39%. And the greatest part about this report is it breaks it down by category. So I'm going to read this part here. The overall property type analysis. The industrial delinquency rate climbed 46 basis points to 1.82%. The amount of industrial loans categorized as AB is 2.14. The lodging delinquency rate jumped 1,642 basis points to 19.13%. The multifamily delinquency rate rose 133 basis points to 3.25%. The office delinquency rate moved up 48 basis points to 2.4%, and the retail delinquency rate spiked 647 basis points. The whole purpose of this part of the report is to show that everybody's being affected. It's not just retail. We've got office, we've got multifamily, all sorts of commercial real estate is being affected, and they're having delinquency rates across the board. And that's going to continue, because when you have less spend in the economy, 70% of the economy is consumer spend, and there is a chain from the consumer spending down into the real estate sector, all sectors of the real estate sector. So when consumers can't spend, as you can see, it affects everything. This is just an amazing report. And again, the hockey sticks. Hockey stick jumps like this are not good. We'll have to monitor this over the next several months, but we definitely need these numbers to come down, or else the economy could be in very serious trouble. And specifically, the commercial real estate sector could be in serious trouble. I want to talk about how some companies are keeping liquid in these times. Of course, it has to do with debt. So here's an article in CFO.com talking about revolver drawdowns keeping corporates liquid. And there is an interesting list here. Now, this is an older list, and this definitely has gone up since this was printed, but a lot of big companies that we see here on this list. General Motors drawing down $16 billion. My goodness. Ford, $15.4 billion. Boeing, $13.8 billion. Shell, $12 billion. And the list goes on down. Live Nation, $120 million. Wendy's, $120 million. Gap, $500 million. So Gap is not only closing stores or drawing down on their credit lines to stay in business. Again, not a healthy retail sector, not a healthy automotive sector, not a healthy airline sector with Boeing, Carnival Cruise Lines, the entertainment sector and the vacation sector, McDonald's, the food sector, Honeywell, the industrial goods and home goods sector, FedEx, of course, the transportation and mail sector, iHeartMedia, of course, the radio sector, Abercrombie, the clothes sector, the container store, the consumer goods sector, all sectors being affected by this. An interesting article I found in Fortune. Wall Street is quietly telling their companies not to draw their loans. So as people are drawing down their credit lines, Wall Street is saying, hey, don't do it. Why is that? And there's one sentence in here that really highlights the issue for Wall Street when companies en masse start drawing down their credit lines for liquidity purposes in a crisis like this. And it says in Fortune, for Wall Street, it's not an issue of liquidity, so they have the money to provide this credit, so much as profitability. Investment-grade revolvers, especially those financed in the heyday of the bull market, i.e. the last 10 years since the last financial crisis, are a low-margin business, and some even lose money. That is key to the longevity and the quality of this debt. As all of these billions of dollars get drawn into these credit lines, the banks aren't going to make a lot of money on that. That's going to put a stressor on the bank bottom lines. And if these companies continue to have to close stores and continue to have lack of sales, that's going to force the Fed to come in and rescue the entire sector from start to finish. They're going to have to try to rescue the consumer because that's 70% of the economy. They're going to have to to backstop some of these loans from Wall Street eventually, and they're going to have to continue to print money to get the liquidity out in the system so that there's enough velocity of money to take care of even the basic things like rent payments to landlords for retail stores and things like that. I think we're about to see, we saw bazookas of trillions of dollars being printed by the world's central banks. The last time I checked, it was 12 trillion. I think now it's up to 15 trillion, something along those lines of money being printed by the world's central banks to deal with the coronavirus epidemic since March. Since March, that's just the last few months. I think more is coming. I think the Fed is going to have to bring out, they're not going to bring out bazookas, they're going to bring out nuclear weapons in this next stage. And they're going to just bomb the market with cash, because if they don't, the banks are going to have issues because of these revolvers. We're going to see higher delinquencies. We're going to see more retailer close downs, and we're going to see definitely more issues in the commercial sector, and it's going to affect the entire commercial area of the economy. So definitely wanted to talk about that, because that's something, especially where I write in Seeking Alpha, a lot of the people writing on the commercial real estate sector are saying, oh, it's not a big deal. All of these ETFs, these REITs, in these ETFs for the real estate sector and all of these real estate companies, oh, they're just fine. Don't worry about it. We see in the data that's not true. And what happens, especially in the REITs, if you're an investor in REITs, there isn't the regulation to force a lot of honesty in REIT reporting. So a lot of the REIT data is not great. And I'm talking about from the government as well. A lot of the government statistics assume payments are being made on a month-to-month basis. They don't go and check that the payments are being made. So the government will report payments being made until somebody says, no, they're actually not being made. So a lot of the data that the government provides on the quality of the REIT sector is incorrect. There's also, due to accounting reasons, not 100% transparency and honesty in the REIT sector in terms of their own internal reporting. So if you're following the data from the REIT sector, you have to exercise caution and take with a grain of salt some of the numbers coming out there. I think what's going to happen over the next several months is we're going to see some extreme pressure forming in the REIT sector and the commercial real estate sector. That's going to start to show up on the balance sheets because eventually they can only hide so much. And I think it's going to start popping out in the government numbers because people are going to start reporting these delinquencies and the government's going to be forced to report them. The government doesn't do the due diligence of all of that data. They just take it as it's reported. So as this starts to come into the data, you're going to see it appearing in the government numbers as well. And it's going to be a shock to people, but it's been going on for the last several months, and eventually it's going to reach the mainstream and the public. You're going to see it in the numbers from the commercial real estate sector. You're going to see it from the retailers. You're going to see it from the REITs. You're going to see it from the government. It's all going to start coming out, I believe, as we get into this third quarter of 2020. So I want to bring this information to you because it looks like we're starting to reach sort of a breaking point here with not only store closings, but a lot of debt creeping into the system, and it's lower quality debt. This is not good for the economy that was already loaded down with a lot of debt. Something definitely to look forward to for the rest of 2020 and monitor to see if the situation gets worse, which I think it will. And that's my prediction, and I'm throwing it out there for you guys. Why don't you guys leave comments and tell me what you think about this situation. And if you've got numbers that contradict this or additional numbers you want to throw out there, throw that out too. I'm a data junkie. I love reviewing that. Okay, for now, this is Robert at goldsilverpros.com. Happy to talk to you guys. Stay tuned for more reports on the economy and on